Hey guys, decided to do another video for you. This time I'm going to do my top 10 majors. Somebody asked me about Northern Star. I did a post today on Twitter of top 25 Australian stocks that he mentioned Northern Star, and I thought I was going to maybe do one on the top 25 in Australia, and I might, but I decided I would do one here on the majors because I know a lot of you um, want to own these. I just noticed that Equinox isn't a major. It's a large mid tier. I'm probably gonna have to fix that. Maybe I'm gonna have to add one. Um, but uh, I know a lot of you probably own majors because, and you might add them because the risk reward is very strong and they're very cheap. We're going to look at the valuations. Um, First thing I wanted to start off with some names that aren't on this list. The first two, there's only one on here that's considered mostly silver, Pan American, but I have it mostly silver because they have 1 billion ounces of silver resources, but their revenue currently is only 25% silver, so it's really a gold miner. Two silver miners that could be on this list that I do have marked as majors in my database. I use the cutoff for a major for me is $3 billion market cap. So we have Hecla and Coeur. Hecla's at 3.4 billion and Coeur's at 4.2. I consider those both majors, so they could actually be on here, but I excluded them. And then we have four gold miners that could easily be on here. As a matter of fact, I think I'm going to replace Equinox with B2 Gold because I think Equinox isn't a major yet. They're going to be one, but right now they're close, 2.7 billion. So they're 300 million away. A hiccup, and they could be one. B2 Gold could be on here. They're 3.3 billion. I think both Equinox and B2 will be at 4 billion fairly quickly. Um, then the other one, the other three that aren't on here that could be is Anglo Gold Ashanti. I didn't put them on here because of location risk. The other one I didn't put on for location risk was Gold Fields. So both Anglo Gold and Gold Fields have quite a bit of production in Africa. But I did include Endeavour Mining, and the reason why is Endeavour's only in Western Africa, whereas Anglo and Gold Fields are all over Africa. They're a little bit bigger. Equinox, Endeavour Mining is a little bit more focused, so I think the risk is a little better there. And then the other one that I don't know who, the other one that probably should be on here is Lundin Gold. Um, they're starting now to uh, thinking about growing their company. They've always been focused in Ecuador. I didn't know about the growth potential, so I wasn't always a real huge fan of Lundin Gold, but they're starting to turn a corner. So I I might leave it as is, but those are the ones that could easily make this top 10. Hecla Core, B2, Anglo Gold, Ashanti Gold Fields, and Lundin Gold. You might have some other names that you think should be on here. You notice the quality, I have them all as A or A minus, except for Equinox. But Equinox, they have very high cost right now, but I'm bullish on them. I like their properties. I'm like right now, I don't have them as a top pick, but I have them as a 4 rating. So they're the highest one on here. I just think that as far as big producers, because I think they produce like 1 million ounces, I think that Evolution probably deserves to be on this list. Um, so we have Equinox is high and Endeavor is high on the risk levels um, because Endeavor's in Western Africa and Equinox. So these are maybe the two stocks. I mean, if you wanted a little bit better risk, you'd go with Lundin and Goldfields, possibly. I think those two probably have a better risk reward than these two. Lundin and Goldfields probably they probably match up better on this list as far as risk rewards go. Um, so yeah, I have it. There's the mid-tier producer. So there's our shares, and here's our market caps. Insider ownership isn't we don't really focus on that. Now we're going to look at debt and cash to see, if any of these have balance sheet problems. So we're looking for a lot of cash and a lot of debt and no cash. So we go down this list. So Endeavor Mining, they have 460 million, so it's not really a problem, but they do have a lot of debt, 1.3. Equinox, this is a kind of a problem on here. So a bit of a stretch maybe to be on this list. And Evolution, not a very good uh, balance sheet, 143 to 1.2. That's one you might pass on, but they're generating a lot of free cash flow, so they could clean this balance sheet up fairly quickly. Kinross, a lot of debt, 2.5. And then Newmont, they're going to generate about four if gold prices maintain where they're at. I think the run rate right now is about 4 billion in free cash flow, so they could really clean up their balance sheet this year. Northern Star probably has the best balance sheet on this list, but it's not great. You can see how these majors like debt, and then Pan American. Um, Here's the multiple. So the highest Alamos at 13 and Agnico at 12, and then everything else is single digits. And if we can find a major, 7 or lower, it's really cheap. We got Endeavor at 3, very cheap. Equinox at a little under 5. And so I think Equinox could easily go to 15. So you're buying it like at a third of its value. That's why it's on here. Um, and then Evolution fairly cheap. Remember, I said it has a lot of free cash flow. We're going to get there. Kinross, still cheap, trading in a multiple under 7. I think all of these majors are going to go to 18. So if Endeavor goes to 18, 15 to 18, that's quite a um, multiple expansion. Agnico, I think it'll double to 24. Alamos, I think it'll get to 24. Barrick, I think it'll get to 20. Um, Kinross, 15 to 18, maybe 20. Newmont, 20. So Newmont, look how cheap it is. Newmont's going to 20, it's at an 8. Northern Star, look at how cheap it is, 6. I think Northern Star gets to 20. And then Pan American, I think if they get to 20. Okay, now we're going to go for their cost. So this is their current cost. This is my estimated break-even cost. So we want everything to be 1,700 or less. So that would give them $1,000 margins. So Agnico Eagle generate a lot of free cash flow at 1,000. Alamos, outstanding, right? $1,200 margins. Barrick, a little high, but they're I think 3.4 million ounces is their production. Here we have the production right here, 3.3. So they're generating, at $2,900, they're generating 3 billion in free cash flow. So well, here's the margins right next to it. So we got $1,400 margins for Alamos. Barrick about 1,000. Endeavor Mining 1,300. Equinox about $900, which isn't bad considering they're mining 1 million ounces. Evolution $1,500 free cash flow. So they're not getting the value. Remember their multiple was only I think 5. So Evolution is very cheap. And then Kinross we have 1850 is kind of high, just below Barrick, but they still have $1,000 margins. And then Newmont 1,900, a little high, but $1,000 margins. And then Northern Star $1,300 margins. Then Pan American, but this is just their gold. But their gold, they are generating a lot of free cash flow, $1,000 margins there. Okay, so um, this is their total resources, reserves and resources, their total. So you can see they all have a lot. Agnico 131 million, Alamos 24, Barrick 142, Endeavor 32, Equinox 43, Evolution 33, Kinross 59, Newmont 195. So they're the big dog now. The Barrick needs to catch up to Northern Star 60 and Pan American 26. So they all have a lot of gold. These are all, long life. Now we're going to look at upside. So we're going to use cash flow. So Agnico's not looking so great here. They're only printing as 100% upside. Um, I'm looking at the wrong thing. This is the one that I wanted. They're looking at, I'm sorry. This is at $4,000 gold. So they're looking at 200%. So they're basically going to go 3x. So that's going to be, they're currently trading at $100. So they're going to go to times three. So they're going to go 400. So 100% would be $200, and then 200% would be 300. I'm sorry, they're going to go to $300, their share price, um, which is actually very good. It's better than, and then the lowest one is Alamos, but they're basically the same. So we have kind of the same upside for both of these at $4,000 gold. And then it gets better. Barrick is actually very cheap. They're trading, they're currently at $4,000 gold. They look at as almost the 3.5 bagger, which is pretty darn good for a company of Barrick size. And then Endeavor Mining 7 bagger, which is kind of crazy, would have that kind of leverage for a major. And now you see why I have Equinox on the board here. Printing is a 9 bagger. And so if they can get their costs down, they have huge leverage. And I do think they're going to be a major very soon. Company of their size, I think the risk reward is okay to be on this list. Evolution is the same as Barrick. They're both 3.5 baggers. And then Kinross is very cheap, almost a 5 bagger for Kinross. And then Newmont, this is kind of a head spinner, almost a 4 bagger for Newmont. Northern Star, a 5 bagger. So these Aussie stocks look pretty darn good. Evolution and Northern Star. And then we got Pan American at almost an 8 bagger. So a lot of leverage in these companies. That's the reason why I want to do this video, to show you these are like, if if the majors have this kind of upside, you can imagine what the mid tiers have. Better than this. And the worst is Alamos at 200%. So let's take a look at a couple of these names. Let's look at Newmont, because you're going, Don, this is a 4 bagger? Are you sure? Doesn't make sense to me. So if it was a 4 bagger, you have to take 46 and you have to multiply it by 5. So 46 times 5, $230. That's what the target is for Newmont. You're going, Don, that's crazy. There's no way they're going to get there. Well, I have their multiple as a 20. Now you might think 20, there's no way they're going to be at 20. They're currently at 9. However, we're talking about $4,000 gold. So once you would get to $3,500 gold, we're going to have a mania in stocks, and people are going to be buying the Barracks and the Newmonts and the Agnico Eagles, pushing up their multiple. They have multiple expansion. It'll rip to 15 very quickly. So by the time we get to $3,500 gold, Newmont is going to have a 15 multiple. So then all you need is multiple expansion from 15 to 20 over that next $500. I don't think it's a stretch. I thought 18, I had it as 18, I moved it to 20. I think 18 is too conservative. Also, these, yeah, they don't have a great balance sheet, 7 billion in debt, 2.7 in cash, but I think they're going to clean this up fairly quickly. They're going to have about 4 billion in free cash flow. this year alone. So here we can see the resources, 95 million ounces. That's a lot of gold in reserves. They're mining 6.5. They're selling some mines, but I think they're going to stay, 6.2, 6.3. Their margins aren't great right now. $1,000 margins, actually, they are great. $1,000 margins. Um, I'm valuing them at 6.5. Maybe that's a little too aggressive. At 1950. So now if we go down here and we look at their future valuations, they're currently trading at an 8 multiple. So if you take their free cash flow and multiply it by 8, this is their current market cap, 53. That's where that multiple comes from. I have their free cash flow, it's currently at 6 at their current cost. I have it doubling basically. It's going to 13 billion in free cash flow. Then if you put a 20 on that, you get to 266. So that's where we get the four bagger. Is all we're doing is taking that increased free cash flow and throwing a multiple on it. Like right here, you take the current free cash flow, you throw a multiple on it. 8 is just super cheap. And the reason why it's cheap is because investors don't want to buy miners right now. And they also don't think that gold's going to stay at 2,900. Because if it does, Newmont's going to be cleaning up its balance sheet. So there's Newmont. Now let's take a look at Barrick. It's twin. Barrick's even cheaper. I have it as a likely three bagger. I have it as an A rating. 3.5 the better, higher the better. That's about as high as you're going to get. So they're currently trading at 18. And if I want to give you so we got 3.5. So you're going to have to multiply it by 4.5. So we take 18 times 4.5. We got $81 is the target. I think that's a legitimate target, 60 to 80, if we go to $4,000 gold. Let's go back up here to the top. Balance sheet is actually pretty good. 4.7 billion in debt, 4 billion in debt in cash. They could clean up this balance sheet very quickly. Current free cash flow is 3.2. So they can't eliminate their debt this year, but they could definitely take, a billion off of it and then maybe next year take another 2 billion off. But in 3 years, they could eliminate their debt if they wanted to, if gold prices stay high. So I'm using 20 for them as well. Future multiplier, I'm using 20. So we're looking at an $80 target. So they're currently mining 3.3 million ounces. Their margins are $1,000. So I have them growing production from 3.3 to 3.5. And I have their cost not going up that much at $2,000. My estimate. So we come down here and we look, they're currently trading about a 10. I think that it's going to double to a 20. So you're basically getting them half off. I have the free cash flow jumping from 3.3 billion at current gold prices to 7 billion at $4,000 gold. So you take 7, multiply it by 20, you get 140 billion. That gives them an $80 share price. Let's see if there's any more we want to take a look at. I guess we could take a quick look at Alamos because it's the one that's not very juicy, if you will. Let's see if I have it, I only have it as 200% increase. So let's see if I have it, I'm being too conservative. Okay, first off, I'm only using a 15 multiple. We could throw a 20 multiple on that. Could easily throw that to an 18. But the issue here, we'll come back to that 15 and see if it's too low. So we look at its balance sheet. It has a good balance sheet. They could easily clean this balance sheet up and get rid of that 250 million in debt and be cash heavy, which is what we want them to do. If they did that, then their multiple would go up. Okay, so they only have 10 million ounces of reserves. So that's the reason why the multiple's only at 15. So that's very light. I mean, it's about half of what Kinross has. So we only have 10 million ounces of reserves. We're mining 500,000. Plus, they have to grow production to 800,000. It's a growth company. A very good margin at $1,400. They're gonna have to maintain that. I have them going up to 1,700. So they're currently at 1,450, and I have them growing to 1,700 and have the growth to go jumping 300,000 ounces. So this one it's not going to be that two bagger. That two bagger is based on 800,000 ounces of production. So they have to get that growth. So we come up here and we see, okay, when are they going to grow that to 500,000? So they're going to add another 150 by the end of 2026. That's not this year, that's next year. That takes them to 650. Then in 2027, 2028, we're expecting them to grow some more. So Alamos doesn't look very juicy at all. I could actually take it off this list and maybe put B2 in there or maybe Lundin in there. But looking at Alamos, I'm not impressed. Um, they could become 900,000, but it's going to be a while. Um, it definitely doesn't deserve anything above 15 because we're looking at, in order for them to even be a two bagger, they have to expand production because this free cash flow, this 1.9 billion, is predicated on them reaching 800,000. They're currently only at 500,000. So this $27 billion market cap is based on production growth, which isn't going to happen until 27, 28. So Alamos doesn't look that good. So I think I'm going to remove it. So we have the next one, since I want to remove Alamos from the list, let's take a look at Lundin and see if Lundin looks a little bit better than Alamos does. So I'm using a 15. We're looking at a balance sheet, which is really good. They don't have any debt. They have 300 million in cash. So we like that. That's going to bump up their multiple. They're low on gold, 5 million, but they're finding more plus acquisitions. They have very good margins, outstanding margins. They're generating a lot of free cash flow. If we come up here and we look at their free cash flow, they're generating 750 million in free cash flow. So in theory, they're going to have $1 billion in cash at the end of this year. So let's look at their growth. So they're at 475. I only have them growing to 500,000. So that's nothing. That's easy to accomplish. Now let's go look and see exactly. So they're at 750 already. I only have them growing to 1.3 and I'm using a 15. So, if I throw a 20 on there, then they look a lot better. I think Lundin looks better than Alamos. Now, that 500,000 is just Fruta del Norte. So now if we take a look and say, I thought these guys were trying to do an acquisition, but I don't have anything in here that says that. There's no notes to say they're making a deal, but I know they're finding more gold at Fruta del Norte. The thing about Lundin, we need for them to do a deal. We need them to grow production. So there's nothing there. So here we go, 500,000 ounces. I only have them at 450, 475. So they're already where I need them to get to. So they're finding more, they're growing. So they're probably going to get to 550. Three-year outlook anticipates, but we don't have any acquisitions. but they're probably going to make one. So if we go in here to Lundin, we change it to a 18. So we have them at 2A. So they're already at 500,000. That means they're actually going to be more. We bump this to 550. Then the multiple, we want to expand the multiple to, I think it's at the bottom. We're going to expand the multiple to an 18. We update that guy. I come over here to Lundin and do a refresh and scroll down. So we just jumped from 200% to 300% just by expanding the multiple to 18 and giving them another 50,000 ounces. So we jumped from 800 to 1.4. They're trading at an 8 multiple now, which is low. So we just having them bump to 50,000 ounces over the next couple of years. It takes them to 300%. Makes that a lot better than Alamos. So it's tough though. It's tough to remove Alamos from the list because people like Alamos. It's like a favorite stock of a lot of people. You take Alamos off of that list, but I could probably replace Equinox with Lundin. But to tell you the truth, I would prefer to remove Alamos and because it's a 2. I can do that. I can remove Alamos and put on Lundin. So we go here to the show and we get rid of Alamos and we add Lundin, shortlist it. Now, yeah, so we're going to do that. We're going to hide him. We're going to save the shortlist, override. I thought I had, yeah, top majors. So this is the new list. We have added Lundin. Oh, I have it as a 2. Let's see, we had 300%, 2.5. We're going back. We're going to change him to a 2.5. Now when we refresh the screen. So now they're all 2.5s and we have Lundin. Much better. So there's your top 10 majors. I would still rank Lundin at the bottom because I don't know. I don't know if it's going to be a 3-bagger, but I like all their cash. I like their balance sheet. So, they're going to pay a dividend. These are also, but I think, Lundin probably deserves to be on that top 10 list. A lot of people are like, Don, where's Alamos? It's got to be on the list. Well, I just explained why it's not on the list. So that's it, guys. There's your overview of the majors. You can give me your feedback. So we'll end it there.